told us that you thought the bottom was in and that new highs were in reach. Now here we are. Now what?
I know this is going to sound counter to what the viewers might think, but I think the stock market is in a better position today than earlier this year when it made its all-time high. Because one, we're now seeing that the U.S. stock market can handle a surge in oil while it hurts other countries. We've seen earnings go up, so we now feel comfortable that the war is actually stimulating the economy. And the third is, I know I've talked before about inflation shocks, but we've been looking back at the history of oil spikes, and the impact on core is less than we thought. So I think there may be less of an inflation shock coming. So I think stocks can go back to that 7,300, which is our base case for this year in our three-phase market, before we might see a larger drawdown.
Well, I hear you essentially saying that the U.S., in some respects, as a result of this war, is the best house in a now more uncertain neighborhood.
That's right. This is the seventh black swan now thrown on investors since 2020. And now we've seen that the U.S. can handle a Middle East catastrophe, one where the strait is closed and oil's not available. The U.S. economy is still operating while other countries are talking about shutdowns and factories closing.
You don't feel in any way, or you're not concerned that you may be complacent to the risks that are still out there because of the war?
There are tail risks. I think that the size of the tail has shrunk, tail meaning a downside risk. And I do think that there's a lot of folks who are credibly pointing out that the shock could still hit the shore in the U.S. because of things like helium and other commodities. So we are watching that, Scott, but I'd also say that we could have a positive tail risk, which is if we can find a lasting ceasefire, then whatever shock hits the shores is so short in effect that it won't hurt our base case.
Something is shifting in the markets right now, and most people are only seeing the surface. Tom Lee is basically saying the quiet part out loud, that everything investors feared is not playing out the way expected. Even with war tensions in the Middle East and oil shocks hitting headlines, the U.S. market isn't breaking. It's actually absorbing it. Earnings are still climbing. Inflation fears from oil spikes are proving weaker than historical patterns suggested. And instead of collapse, we're seeing resilience build underneath the chaos. And here's the part most miss. When fear events stop acting like crash triggers, markets don't just recover, they re-rate higher. Tom Lee is hinting that the U.S. has become the strongest house in a dangerous neighborhood, pulling capital while global uncertainty rises. And in that environment, tech becomes the engine again. With Bitcoin and Ethereum already moving like high beta reflections of that risk appetite. But the real question he leaves hanging is this. If all the downside shocks are shrinking, what happens when liquidity fully returns? Let's go into what he actually said.
The NASDAQ is trying for its 11th straight positive day. It'd be the longest streak since November of 2021. There are those who believe, like JP Morgan does, that if the next leg of the rally is going to be strong, tech is going to have to lead. Do you agree with that call?
Yeah, we do. I think that it's still useful for people to look at what has outperformed since the war started. And, number one has been Ethereum and Bitcoin, which are crypto, but they're highly correlated to tech. Of course, there's energy stocks, but then it's led by tech, and the Mag 7, and even the software. So I think that JP Morgan's correct. I think tech is growth when people are worried about growth. And of course, it's also been the most under-owned group because that's the group people were selling.
Well, part of the call is that you're going to get the best earnings growth from tech. There are more notes about that today, while at the same time, valuations have fallen. So these stocks in some people's eyes aren't as pricey as they used to be and look even more attractive because earnings growth estimates are solid, if not increasing.
That sounds right, Scott. These companies have true moats. They've grown earnings consistently faster than the S&P. I think they're going to be one of the winners around AI. And you're right, to buy them at a market multiple means that 5 years from now, I think people are going to be surprised that they could buy them so cheaply.
Everyone thinks war should break the market. But what if it's secretly fueling it? That's the uncomfortable signal Tom Lee is pointing to. While headlines scream crisis, money is quietly flowing in the opposite direction. Defense spending is exploding, tens of billions every single month, injecting liquidity straight into the system. And the shock from rising oil? It's there, but far smaller than people fear. Just enough to scare, not enough to stop anything. So instead of collapse, earnings are holding, even growing. And here's what most people are missing. Markets don't wait for clarity. They move on expectation. Just like in World War II, the bottom came before the outcome was even known. That means this rally isn't reacting to today. It's pricing in something ahead. Something better, or at least something not as bad as feared. But here's the tension. If the market is already looking past the worst, then what happens if the outcome actually improves? That's where the real move begins. Listen carefully, because Tom Lee is about to explain what the market is quietly betting on.
They will say the ever bullish Tom Lee was ever bullish, but you were also right. I mean, is there anything that is going to stop stocks right now, Tom? Because they just keep going up.
Well, I think stocks are holding up because the economy's actually doing better in the face of this war. And I know it sounds counterintuitive, but part of it is the defense spending, at $30 billion a month, and it may end up being, $60 billion a month. That's actually quite stimulative to the economy. This $20 rise in oil is only adding about $12 billion a month to the household burden. So on sort of net basis, the war is actually helping earnings right now.
Yeah, and it's hard to admit this because I do know that gasoline prices for a lot of families out there are a major cost, especially with all the other inflation of the last 5 years. But with car mileage per gallon up, if you do the math, you're looking at maybe $50 to $100 per family per month in extra cost right now. Again, it's not insignificant. I want to be mindful of that. But it sounds like you're saying that is not enough to damage the economy and thus damage corporate earnings and the markets.
That's right, Brian. I mean, nobody wants the U.S. to be at war.
No.
And of course, we're caught in a fog of war. I do think one of the things we have to remember, even like going back to World War II, the stock market bottomed in May 1942, 5 months after the U.S. entered the war, but before any U.S. troops were even on the ground, either in the Pacific or in Europe. So the market does have a really good way of sort of discounting outcomes. And I think the reason it's going up is I think we're going to end up with a favorable outcome, which I can't say I know why, but that's what it looks like.
Well, and things could change, and I want to get your take on that because let's pray for peace and hope that things tone down. We did have a power poll. I wanted to hear from our viewers and all of our ex-followers and whatever about how they feel. And we asked a very simple question, Tom. It was what matters most for the markets right now? Is it the Iran war? Is it corporate earnings, which are starting to roll out? Or is it interest rates? People can vote now by clicking on the QR code. How would Tom Lee vote on that?
Well, I would say that of those three, only one can create tail events on both sides, which is the Iran war. So I think that the most important thing to watch and to really be mindful of is the war.
Okay, because the other ones already known? Earnings for the first quarter won't be that affected because the war began basically at the beginning of March. So we only have 1 of 3 months where you've got some energy disruptions. The second quarter numbers will be slightly different. So with that in mind, how closely are you and your team going to be watching first quarter earnings versus second quarter earnings, which will maybe fully price in much of what we're seeing?
Yeah, Brian, we're going to watch both because, as you know, some groups in the S&P are going to be affected immediately by higher transport costs or availability of commodities. And so we're going to get a pretty good picture of sort of that disruption that is working its way through. And of course, that gives us a hint to the inflation shock that's coming. But all that being said, as you know, the the world and the U.S. has been dealing with a series of shocks over the last 5 years. So in some ways, I'm not saying the market's becoming desensitized to it, but it's learning to not go into a full-blown panic.
And you still, we're going to wrap it up, Tom. I think you still have your 7,700 price target on the S&P and some individual names. You got the One Oak, Texas Pacific Land, Quanta. Sounds like you're all in on the energy expansion and growth story.
Yes, and I think it's highlighting an important theme over the last few years, which is that every country wants three types of security. They want energy security, they want sovereign security, and they want cybersecurity. So I think all of those are going to be good areas for where spending grows, and stocks should do pretty well.